And on today's show, is a qualified plan always better than a non-qualified life insurance plan? Part 4 of this week's series, Life Insurance for Tax-Free Income, with co-host and nationally recognized insurance product expert, Mike McGlothlin. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician and Insmart. Let's get down to business. Well, welcome to the show, Mike.
It's great to be back.
Well, day 4, we're talking about, this is a big debate online. Every time I bring this up, all the fund people attack us, and I'm just trying to be fair. We're talking about qualified plan versus non-qualified plan. But let's get out the good stuff first. If you're in a high tax bracket, or if your employer is matching, or if you're in a high tax bracket and he's matching, I'm doing a 401k all day long.
Yeah, I'm going to take as much free money from my employer as possible.
Absolutely, and I'm doing it. My tax bracket's high. I'll take the tax relief. I'll take the free money. I'm doing that all day long. But it's interesting, Mike, this is such a hard thing to talk about because people are so used to doing 401ks. I'm all over 401ks. If you're in a high tax bracket or you're getting a match from your employer, call it a day. I'm not ready to discuss it. But if you don't have a high tax bracket or you're not getting a match, I think you need to start looking at this. If the average middle American is contributing about $1,000 a year, which doesn't sound like a lot, maybe $1,200, you may only be saving $180 to $200 in taxes today. You also are giving up basis and Social Security benefit issues later on. Talk about the impact of this, because this matters.
Yeah, you take a look at an impact of married filing jointly here with most Americans. They're looking at between a 15 to 25% tax bracket. So, putting aside $1,000, they're basically saving $200 to maximum $250, probably closer to $230 with the effective tax bracket. Just as you said, I'm going to leverage $230 today. For 20 years down the road, I'm going to get that $1,000 out plus gain, and I'm going to be at that current tax bracket, which hopefully in 20 years, I'm at a higher tax bracket just from wage earnings and from savings and investments down the road. So you really have to take a look at, and I know it's a crystal ball as to what tax rates are going to be, but we can probably assume that the chances are that tax rates are going to be higher down the road in some form, whether it be capital gains or whatever. I think that today, that may be a small benefit to have in order to get really severely taxed down the road.
When you're considering it, you need to do the full examination and analysis to find out what's the best way to go. If I'm a middle-class American and I'm looking for, I'm already conditioned to having this taken out of payroll, so I could understand very easily dollar cost averaging on a monthly basis into a life insurance contract. My issue is if I'm not getting a match and I'm in a low tax bracket anyways, blended tax bracket, most middle Americans are, they probably should be looking at this as another alternative, which they haven't done in a long time. But you brought up another side point again. We're talking about, excuse me, let me get that one up, Social Security. Now, we looked at this yesterday, and Mike walked through this. If you missed our show yesterday, hop out to the site on Wednesday's show, because Mike actually walked through the Social Security and the secondary step, the provisional income test, to show you how this impacts retirees. My goal, if I was not in a qualified ERISA 401k, I still have basis in my life insurance. That's coming out free. My actual policy loans to gain under current tax law is coming out free. It's not going to ever fall on any of these two-step processes.
Absolutely. And when you think about not impacting this, $25,000 in today's terms for a husband and wife, average American, and not getting taxed on either 50 or 85% of that, that alone more than doubles the tax savings that you have from that $250 savings that you have by putting your $1,000 in there. So when we're taking a look at income planning, so many people fail to take a look at what you keep. And this is one thing that we really have to keep in mind, because it's a large portion of middle America's impact. From an asset base, it can be more than a $100,000 decision, and making sure that we treat that $100,000 decision properly is really critical in the planning process.
We're looking now at just a traditional 401k plan and an expense that people don't see off the fund all the time. And we're looking at the estimated cost of record keeping. Now, there's admin charges for qualified plans. I'm not talking about the employer side of this equation. Fair enough. Let's just talk about the employee side. They're going to be paying a little bit for the 404A compliance. Has a cost to it. Somebody's paying it.
Yeah.
And whether it's downloaded directly to the employer or the employee, somebody's picking it up. But now with the new, this 2 years ago, the 408B2 full disclosure, they have to say everything that the fund's into. Fund charges, the statement of information, the record keeping fees, this all has to be now disclosed.
Yeah, and when you think about it, this is a fairly inexpensive one, but at the same time, keep in mind this goes on top of, this is just record keeping. This doesn't go into the account fees, the management fees, all those types of things. And I think one thing that we sometimes gloss over is that in the last couple of years, the person or advisor who's actually doing this plan, he can't provide fiduciary advice to you. So you're going to have to go to another advisor to get that RIA type of fiduciary, which goes on top of all these things like we talked about on Monday.
This is very interesting, and you need to keep in mind, all we're looking at and comparing is, are you in a high tax bracket or no? Are you getting matched or not? And now we're looking at the expenses of playing in this. I need to see the full net result, the total fee drag, tax drag, all the options, especially when I come out in distribution. I'm not willing to give up basis any longer. I need to look at it. When we come back from the break, we're going to continue looking at qualified. Now we're going to look at a little bit at non-qualified and let you compare it and come to a decision yourself. It's not how much money you make for your clients, it's how much money they get to keep, especially in retirement. But retirement income could cause Social Security benefits to be taxed. One tax advantage alternative is life insurance designed as a non-modified endowment contract that can generate tax-free income without taxing Social Security benefits. These contracts offer differing funding options depending upon your client's risk tolerance. For more information on how life insurance can be part of your retirement planning, just email me at steve@downtobusiness.tv. Brought to you by Ash Brokerage, the practice enhancement company. Well, welcome back to our second segment. I'm with my co-host, Mike McGlothlin. Mike, we're looking at a contract from Allianz, one of our top income indexed carriers, and they are on they're ranked in almost every grid I've seen, top 3. So these guys are players. Now I'm looking at a traditional female, and I love how you talked about this earlier in the week about half of all America's in the wrong rate class, whether it's indemnification or in income. And this really matters when we're talking in income, because our goal is to bring the cost of insurance down as low as we can so that the internal rate of return can go up. And remember, the difference between the same male and female, 45, even if they were both super preferred non-smoker, that could be 35 basis points day one difference.
Easily, yeah.
So it matters. Now, we're showing a basic layout, a female, 45, non-smoker, super preferred, 10,000 layout. Distributions are about 57,460. There's only one other carrier right now that's in this, or actually 2 carriers are in this range. It's funny how it's first place, second place, and third place are all in this range. When you get to fourth place, it drops almost $7,000. So it really matters. So when I'm looking at this, I see the premium outlay stops in the 65th, my age 65, and I start taking tax-free income. And then it goes all the way out. And by the way, a little side note on Allianz, interesting, I told the computer, stop at age 100. But their illustration always shows to 120. So I called up Allianz and I said, now is that number real after age 100? What if I became the Guinness Book of World Records, lived to 122 like Jean Clement? You know what I mean? I'm thinking, she says, yeah, that number is there. So even though I asked the computer to go 0 at age 100, that premium continues past age 100. Now, to me, that's a huge issue, because you look at the total rate of return now, that's a completely off the rails. So here's a perfect example of this, but here's what I wanted to get in on this contract and show you. Here are the expense loads. Okay, now, Mike, here's where we get into, if we're going to argue, here's where we're going to argue. I have a $10,000 premium, and I have to pay $500, so I got 5% right out of the get-go. And if I add now, it's 5.9% of charge. This is what, and I'm fully disclosing it as I've been doing it for almost 30 years. And so I'm looking at these 2 charges here. Now, I also have my cost of insurance charge and my per unit. Talk about some of these charges and walk me through the grid.
Well, again, I think you have to take a look at, compared to what's key here with Allianz is their per unit charge is really only there for the first 10 years. So when you take a look at break-even analysis and things like that, it really comes into play, again, depending upon cash value, anywhere from year 11 to year 13. But what you're really playing on here is income distributions. So yeah, every time you put in a premium deposit charge, just like you would on any type of mutual fund. And as we talked on, I think it was on Tuesday, we talked about some of the policy charges. Got to issue the policy, got to underwrite it, got to do all the things. So there's going to be an annual maintenance charge for statements and things like that. cost of insurance. This is the real variable that you can really kind of control by choosing the right surrogate, by choosing the right person, by making sure that you go back through underwriting if you're rated, to go back every couple years and to make sure and drive down that cost as much as possible. Now, what's interesting here is that you see that cost of insurance going up and then going down. That's a reflection of what we talked about on the first days in terms of lowering that face amount as low as possible, and they've got some cash value. So the net amount of risk to the carrier has actually decreased. And so some of those cost of insurance goes down in years 11 and 12, which is right when you want to try to be pumping in premium and growing and getting in a position for income.
Well, in this case, we're clearing the 10th year. Now I've lost an expense. When I stop making premium payments, I'm losing a premium load. I'm losing that. I'm still continuing the policy fee for infinitum, but I noticed another, look at this demarcation line at the distribution date 65. I'm increasing, all of a sudden dropped again because the designer, just happened to be me, I designed this to drop again to the quarter to try to get it as low as I can to manage this out. And if I could levelize it, and I tried to see which one was better, I looked at that, and those are my expenses. So when I'm looking at this, and we've done some research on this in-house, where we've seen about 8-9 years, your actual expense loads against a qualified plan. Now, again, keep in mind, I'm even throwing in the $200 savings that Middle America might be getting on this. Let's just say that that's true. And I'm going to put that back in and look at that number, but I'm also going to take out the term life insurance because that would be fair for the equation. I'm about the 8th year where my numbers start to become kind of even, where I'm actually paying about the same. But it isn't until about the 11th or 12th year, somewhere in that vicinity, where I actually now become better from an expense load point of view, and that's where the real drama comes here. Basis, we preserve basis by doing this. We will not have any influence on Social Security taxation whatsoever. When you start putting those numbers against a full lifestyle model, well, that's all the time we have for today. Remember, before moving forward with any of the ideas on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? Just go out to our site, downtobusiness.ashbrokerage.com. Want to email me? steve@downtobusiness.tv. And remember, you could be wiser as an Ash Brokerage advisor. I'm Steve Savant with Mike McGlothlin. We'll see you tomorrow.